Suisse had hosted the management of SBI Cards, and some of the key takeaways are that the management of SBI Cards sees the impact of the COVID second wave to be lower than the first wave. In fact, there is going to be recovery in spends, and also the asset quality outcome is likely to be better than the COVID first wave. Management did state that the spends had fallen close to around 10 to 15% in the month of April and May versus second half of FY21. However, that has recovered in June 2021. While lower spends, restructuring and tighter credit filters may help keep the share of revolvers lower than the historic levels, continued moderation in funding cost is likely to offset some of the pressure on the net interest margins. However, the overall net interest income growth is still likely to lag the asset growth in FY22. Over the past year, SBI Cards management has tightened credit filters and increased the share of sourcing from the banker channel, which forms close to around 55% of the overall sourcing. Also, the stage 2 loans are back to pre-COVID levels at 7.5, and that should also help contain the future slippages. This is the stage 2 loans x the restructured loans. However, despite this, Credit Suisse has gone ahead and built in higher level of slippages, nearly around 10% in FY22, and that should partly led by the stress coming in from the existing restructured book. Even as Credit Suisse is building in higher credit cost, which is nearly around 9% in FY22 versus the 6 to 6.5% seen in the pre-COVID levels, they do believe that the overall SBI cards would be able to maintain a very healthy profitability with return of assets of anywhere around 6% and the company is likely to benefit significantly from rising digitization. They've gone ahead and cut the FY22, FY23 EPS by 8% on lower spends and higher credit costs, but they still maintain an outperform rating on SBI cards. In fact, in an exclusive interview with ET Now at the time of the Q4 results itself, management had stated that it was too early to comment on the COVID second wave. They had already increased the provision cover and they would be seeing some amount of softening in the spends or postponement of these spends, and hence they were fairly conservative in terms of the provisions. Certain states like Maharashtra, Delhi, Rajasthan had put in certain amount of restrictions at that point in time. This is sometime in April that I'm speaking about, and at that point in time they had seen softening of the spends. Management had also mentioned that they had partnered with Paytm, Google Pay. There is competition. E-commerce play is seen in tier 2 as well as tier 3 markets, and digital payment space is increasing, but the overall cake size is also increasing, and SBI cards is not really disturbed by the competition. In fact, they are seeing good amount of opportunity on account of the digitization, and that Carlyle still holds nearly around 11.6% stake in SBI cards and continues to be part of the board. Thank you for watching.